In the first half of 2022, China invested $28.4 billion in the 147 Belt and Road Initiative countries. This is 47% more than the originally stated transactions of H1 2021 and nearly the same as the amended numbers. $11.8 billion was invested, and $16.5 billion was constructed contracts, partly financed by Chinese loans. China's engagement has grown steadily since 2020, compared to $48.5 billion in the first 6 months of 2019. Compared to the first quarter of 2022, BRI involvement declined considerably. Since 2013, the BRI has engaged $932 billion in construction contracts and non-financial investments. The Chinese Ministry of Commerce, MoFCOM, released data on China's investments and cooperation with nations along the Belt and Road, from January to May 2022 on June 28, 2022. These data show that Chinese companies invested $89.9 billion in non-financial direct investments in nations along the Belt and Road, a 10.2% increase. 1.840 new projects with a total contract value of over $38 million were signed, down 18.3% from the previous year. 55 nations along the Belt and Road, including South Asia, are covered by MoFCOM statistics. By June 2022, 147 nations had signed a Belt and Road Initiative cooperation agreement with China. We use the China Global Investment Tracker and data from the Green Finance and Development Center at FISF Fudan University, Shanghai. Most data is flawed and needs constant updating. Chinese investment in construction in the BRI increased to 42% in the first half of 2022 from 26% in 2021. Chinese BRI involvement was 58% construction in H1 2022. Chinese financial institutions and contractors finance many construction contracts, with host nation government entities guaranteeing the project. Investment deals are growing, and construction is shrinking. Investments averaged $456 million in H1 2022, up from $394 million in 2021. 2014 investment deals were 75% smaller than in 2015. In H2 2022, building project deals were $5,324 million, down from $558 million in 2021. Large investment deals supported by oil and gas may have raised average values. Construction projects were smaller, partly because sovereign guarantees became tougher to obtain due to tighter recipient government budgets and Chinese financial institutions' risk management approaches. BRI nations outperform others. BRI countries outpaced non-BRI countries by $9 billion in investment deals and $15 billion in construction participation in H1 2022. Strong Middle Eastern and East Asian engagement. China built 35 in 15 BRI nations in H1 2022. The Philippines, Serbia, and Iraq made the most. BRI investments went to Saudi Arabia, the Democratic Republic of Congo, and Indonesia. East Asia's investment share dropped from 48.8% to 10.7%. Russia, Egypt, and China's Pakistan CPEC engagement dropped 56% from H1 2021. BRI energy engagement. Chinese BRI engagement is mostly energy-related. Energy involvement totaled $11.9 billion in H1 2022. Compared to H1 2021's $8.8 billion engagement and 2019's $18 billion. Gas, 56%, solar and wind, 18%, and oil, 18%, were the main energy sources in H1 2022. Coal. China has said it will not build new coal-fired power plants as part of its One Belt One Road infrastructure projects. There are 11.2 gigawatts of projects that have money and permits but have yet to start construction. Captive power plants are another issue, with plans for a 4x 380 megawatt thermal power plant on Obi Island, Indonesia, in February 2022. Hydrocarbons. 80% of Chinese foreign energy investments and 66% of Chinese construction contracts were oil and gas. China's gas commitments totaled $9.5 billion in 2021 and $6.7 billion in the first half of 2022. Saudi Arabia received $4.6 billion in gas investments, followed by Iraq. In H1 2022, China invested $2.2 billion in oil-related BRI projects, 18% of its total energy investment. Iraq, Uganda, Algeria, and Ecuador were awarded these contracts. Green hydropower. In H1 2022, China invested $3 billion in solar, wind, and hydropower. H1 2021 had $3.8 billion engagement, and H1 2018 saw $6.5 billion. In H1 2022, Chinese green energy and hydropower investment totaled $1.4 billion compared to $400 million in H1 2021. Green energy construction, including hydropower, fell from $3.4 billion in H1 2021 to $1.6 billion in H1 2022. Country-specific energy involvement. In H1 2022, Saudi Arabia and Iraq received the highest Chinese energy engagement in BRI countries. Between 2013 and 2022, Iraq was the BRI's third most important energy partner, while Saudi Arabia rose to fourth, Pakistan's most important partner, followed by the Russian Federation. Aramco and an international investor group led by BlackRock and Hassana collaborate on the lease and leaseback arrangement, previously announced on December 6, 2021. Keppel Infrastructure Trust, Silk Road Fund, and China Merchants Capital lead the consortium of institutional investors. Saudi Arabia cooperated with Jinko Solar on a $210 million solar project. Transport engagement in the Belt and Road Initiative is crucial to trade between China and BRI nations. China has built road, rail, aviation, shipping, and logistics projects worldwide. Aviation. Tanzania announced one $190 million aviation-related construction project in H1 2022. Rail. In H1 2022, most Chinese rail projects were in East Asia, including the continuation of high-speed rail projects from China via Thailand and Malaysia to Singapore, Kunming-Singapore Rail. The 422 km China-Laos Railway opened in December 2021. A Chinese consortium was given a $2.8 billion contract by the Philippines Department of Transportation, DOTR, to develop the first phase of the 565 km Bicol rail system on Luzon in January. Siemens secured an $8.7 billion rail project in Egypt in May 2022, although no new African rail engagements were announced. Road transport. China builds roads in several nations. A 2014 Kenyan $70 million road annuity project with 66 kilometers is still unbuilt. China invested $8.7 billion in road infrastructure in H1 2022, up from $7.5 billion in H1 2021 and $14 billion in H1 2019. 88% of transport projects were construction, while several road projects were investment projects, similar to the road annuity project in Kenya mentioned above. Ports. H1 2022 saw no port projects. Key BRI investors. Only Chinese SOEs invested in BRI in H1 2022. China Railway Engineering, China Communications Construction, and Power China led BRI construction projects in H1 2022. The Silk Road Fund and China Merchants Bank were major investors in the Saudi Arabia-Aramco oil deal partnership. BRI investments worldwide. After the 2020 slowdown, global FDI rebounded in 2022. In June 2022, UNCTAD reported that FDI rose 64% to $1.58 trillion in 2021. In 2021, worldwide FDI reached pre-pandemic levels. From 2020 to 2021, FDI in developed economies rose 134%. Cross-border M&A and high multinational enterprise retained earnings doubled U.S. inflows. In 2021, developing nations, including many BRI countries, received $837 billion in FDI, up 30%. 40% without China. In 2021, developing nations received $837 billion more FDI than developed countries, $746. East and Southeast Asia received record FDI in 2021. Mainland China and Hong Kong received $322 billion up 13% from 2020. From 2020 to 2021, African countries increased 113%, from $39 to $83 billion, largely due to one transaction in South Africa. At $39 billion, continental greenfield announcements remained weak. International project finance deals targeting Africa increased by 26% to 116 and 336% to $121 billion, from $36 billion in 2020. Power, $56 billion, and renewables, $26 billion, led. FDI in established industries like automotive manufacturing, financial and insurance services, and electricity provision rose 56% from $86 to $134 billion in Latin America. May 2022 saw the highest FDI index score since July 2019. Global FDI outpaces BRI investments. From 2020 to 2021, emerging market FDI outside China rose by 40%. In 2020-2021, Chinese BRI investments fell 25%. The top 4 worldwide external FDI comes from China. China was the 4th largest outbound investor in 2022, with $145 billion in FDI and M&A. Japan contributed $147 billion, Germany $152 billion, US $403 billion. Renewable energy project funding dominates globally. Emerging economies invested $35 billion in 144 renewable energy projects, up 24% from 2020 but down 13% from 2019. Non-renewable energy investments were barely $4 billion. Compared to 80% of private sector finance in affluent countries, almost half of emerging economy projects require public sector participation. FDI forecast for 2022. UNCTAD predicts worrisome FDI in 2022. New project activity dropped 21% in the first quarter of 2022, and foreign project finance deals fell 4%. The war in Ukraine, COVID-19, and China's lockdowns contribute to this. This raises financing concerns, especially in emerging markets experiencing a triple crisis of inflation, currency rate risks, and sovereign debt risks. BRI Finance and Investment Outlook. The Chinese Ministry of Commerce has slowed foreign expansion in its 14th five-year plan, FYP, for 2021 to 2025, investing $550 billion, including non-BRI countries, down 25% from 2016 to 2020. Chinese contracting volume is expected to drop from $800 billion in the previous FYP to $700 billion this FYP. We see an opportunity to invest in the early phase out of older coal projects, which would be economically and environmentally beneficial. Instead, Chinese stakeholders and multilateral partners should promote green projects. Tripartite cooperation with international finance and implementation partners can improve BRI project funding, risk sharing, and knowledge sharing. Expanding international cooperation could help Chinese financial institutions de-risk project finance. Increase the use of common environmental and social standards in project evaluation, e.g., Environmental Impact Assessment (EIA), and Ecological and Social Risk Management (ESMS). Chinese financial institutions can raise cash on global capital markets, speed up co-financing with international partners, and meet the Green Belt and Road ambition by applying international norms. Chinese foreign investors must use independent environmental impact assessments (EIA) and strict environmental and social risk management (ESMS).